All right, let's talk about gold, because the last 72 hours have been an absolute roller coaster ride, one that's left even the most seasoned investors completely breathless. So we're going to break it all down: what happened, why it happened, and what some of the biggest players on the planet are doing right now.
Just listen to this. The steepest one-day percentage decline since 1983. Let that sink in for a second. We're not talking about just a bad day here. This was a level of chaos, of pure panic, that the market hasn't seen in over 40 years. A genuine financial shockwave.
Okay, so to really understand what went down, we need to look at three key numbers. Think of them as the timeline of this whole event, and you've got to pay close attention here, because it's the speed of these moves that's the real key to this whole story.
First up, the peak. Just a few days ago, gold blasted to an all-time record high, almost $5,600 an ounce. Can you imagine? The market was absolutely euphoric. It really felt like the only way was up.
And then, bam, the floor just completely fell out. In the span of just 2 days, the price collapsed by a staggering 13%. I mean, to put that into perspective for you, that's the kind of drop that can wipe out months and months of gains in the blink of an eye. Absolutely brutal.
But wait, it gets crazier. To complete the whiplash, just as fast as it crashed, gold staged this massive rebound, surging over 6% in a single day. So you've got this insane peak, a catastrophic drop, and then a huge bounce. The big question is, what on earth could cause swings this violent?
Well, to understand this level of chaos, you have to realize it wasn't just one thing. It was a whole series of events that, believe it or not, collided at the exact same time. It's what experts are calling a perfect storm.
So, what exactly caused this perfect storm? What were the ingredients that came together to create such a massive sell-off?
It really boils down to three major things that all hit at once. First, you had the Fed sending out what they call hawkish signals. Now, all that means is they were hinting at raising interest rates. And when rates go up, an asset like gold, which doesn't pay you anything, starts to look a little less attractive. Second, there was a big technical squeeze from the futures exchange. We'll get to that in a sec. And third, a surprise trade deal between the US and India suddenly eased some geopolitical tension. And, less tension means less demand for gold as a safe haven. The crazy part is that each of these things just amplified the others.
Okay, let's zoom in on that second point, because it's a huge piece of the puzzle: margin hikes. So a lot of traders don't just use their own money. They use leverage, right? Borrowed money to make bigger bets. Well, the exchange suddenly said, hey, you need to put up more cash as collateral. This is what's known as a margin call. And if you can't come up with the cash, you're forced to sell, instantly, at any price. This created a fire sale, and that's what really accelerated the crash.
But here's where the story takes a fascinating turn. While all those speculators were being forced to sell in a panic, a very different and way more powerful player was quietly stepping into the market. We're talking about the world's central banks. They were the ones who basically put a floor under this whole thing.
And get a load of this number. Central banks are on track to buy a net 800 tons of gold in 2026. That is just a staggering amount. And this isn't short-term gambling, not at all. This is strategic, long-term buying. It creates this massive underlying demand that basically acts as a safety net for the whole market.
So the big question is, why? Why are they buying so much? Well, it's a few key reasons. They're trying to diversify away from relying too much on the US dollar. They're hedging against global instability and political risk. And of course, they're worried about inflation and government debt. So you see, unlike a trader who panics, a central bank looks at a crash like this and sees one thing: a massive discount. It's a strategic buying opportunity for them.
And all of this buying, this incredible institutional demand, has given the world's biggest investment banks a whole lot of confidence. So much so that they're making some pretty bold predictions about where gold is headed next.
Just take a look at the consensus view from Wall Street. Even after that huge crash, you've got the heavy hitters. We're talking JP Morgan, UBS, Deutsche Bank, all calling for prices way above that recent peak. Some are even looking at $6,300. For them, the trend is clear. That central bank buying is just too powerful of a force to ignore.
Okay, so the big banks are clearly bullish. But what about the people who are actually on the front lines? The traders who live and breathe this market every single day. Well, their perspective gives us a really interesting and much more cautious counterpoint to all that optimism.
This quote from an analyst really captures the mood on the trading floor perfectly. "I'm in a wait-and-watch situation. It's better not to trade." I mean, can you blame them? After a swing that violent, the folks on the ground are really hesitant. They see a market that just went through something, well, dramatic, and they think the smartest move right now is just to stay on the sidelines.
And that's because, from a trader's point of view, that big bounce we saw isn't a clear signal to jump back in. Remember, their timeline is minutes and hours, not years like a central bank. After a crash this bad, they're terrified of getting caught in another big drop. So right now, to them, the market has no real direction. They think the big players are just sitting back, waiting for the dust to settle. There's just no conviction out there.
And this really brings us to the core conflict, the central puzzle of the gold market right now. On one side, you have these incredibly powerful, long-term buyers with super deep pockets, and on the other side, you've got all this short-term fear and uncertainty on the trading floor. It really sets up a fundamental battle for control of the market.
It's really like a tug of war. The forces pulling towards stability, that's the central banks, with their massive, steady buying and the general demand for gold as a safe haven. But pulling hard in the other direction are the forces for volatility, things like uncertainty over what the Fed will do next and all that speculative trading we talked about. Two massive forces pulling in opposite directions.
And so, that leaves us with the big multi-billion-dollar question, doesn't it? Will the steady hand of the central banks win out, calming the market and leading to that stable climb higher that the big banks are predicting? Or will the fear and uncertainty on the trading floor take over, sending us on another wild ride? The truth is, even the experts can't agree, and that means for now, the only real certainty in the gold market is more uncertainty.